This video will walk through the disclosure requirements in the proposed accounting standards update for the disaggregation of income statement expenses, also referred to as DICE. The board is issuing this proposed update to address requests from investors for more detailed information about certain types of expenses that are included in expense captions commonly presented on the face of the income statement.
Let's begin by looking at the left-hand side of this slide, which depicts a fairly typical income statement presentation for a public company that is a manufacturer. Today, there are few income statement presentation requirements in the codification. The captions that public companies present on the income statement are generally established by the SEC, and the board recognizes that there is significant variability in how entities label and present expense captions. The objective of this proposal is to further disaggregate expenses in the notes to the financial statements. The following slides illustrate how the disaggregation requirements would be applied. We're going to use this example throughout the video to describe the key terms of the proposed update. On the right side of this slide, in the box labeled Scope, we explain which entities would be required to apply this proposed guidance. The requirements would only apply to public business entities, which, among others, include public companies that file or furnish financial statements with the SEC. That means the requirements do not apply to private companies, not-for-profit entities, or employee benefit plans. Also, in the box labeled Scope, we explain which expense captions would be required to be disaggregated. An expense caption would only be disaggregated if it contains at least one of the following natural expense categories: inventory and manufacturing expense, which has additional requirements that we'll describe later, employee compensation, depreciation, intangible asset amortization, or depreciation, depletion, and amortization from oil and gas producing activities, or DD&A. If you take a look at the example income statement on the left hand of this slide, it is expected that cost of products sold, cost of services, and selling general and administrative, or SG&A, would generally be relevant expense captions that need to be disaggregated due to the likelihood that those expense captions contain at least one of those required natural expense categories. By contrast, both interest expense and income tax expense would likely not be disaggregated because generally neither caption contains any of the required natural expense categories. The next slide shows the disaggregation of expense amounts for each of the required categories discussed on the previous slide that are included in cost of products sold, cost of services, and SG&A. Today, depreciation and amortization are each required to be disclosed in total, but there is no requirement to disclose the amount of those expenses that are included in each caption presented on the face of the income statement. Additionally, there is no requirement to disclose total employee compensation expense or inventory and manufacturing expense. In this example, you can see the amount of employee compensation included in each of those expense captions. Similarly, you can see how much depreciation and intangible asset amortization are included in each caption as well. Inventory and manufacturing expense is recognized entirely within cost of products sold. Next, you'll notice that the example shows an amount for warranty expense included in cost of products sold and an amount for the impairment of PP&E that is included in SG&A. Neither of those two expenses are included in the list of natural expense categories that require an expense caption to be further disaggregated. This illustrates another requirement of the proposed amendments. Entities should integrate certain existing disclosures into the same tabular format disclosure as the proposed new disaggregation requirements. There are two parts to this requirement. First, this requirement would apply to certain amounts that are already required to be disclosed if they are recognized in only one expense caption. For example, an entity may recognize warranty expense only in cost of products sold, and therefore, the entity would include warranty expense in the disclosure for the disaggregation of cost of products sold. Second, this requirement would also apply to certain existing disclosures for which both the amount and the corresponding income statement caption currently are required to be disclosed. For example, for impairments of PP&E, entities are currently required to disclose the caption or captions on the income statement in which the impairment amount is recognized. So those amounts would also be included in the expense disaggregation disclosures. The proposed update includes lists that specify which existing disclosures should be integrated into these disclosures if applicable. It's important to note that the existence of the expenses in these two lists does not trigger the requirement to disaggregate the corresponding expense caption. Rather, as stated before, an expense caption is only subject to the disaggregation requirements if it contains at least one of the required expense categories that were mentioned previously. Therefore, if an expense caption does not contain any of the required expense categories, but for example, contains warranty expense, an entity would not be required to disclose the disaggregation of that expense caption. As a result of the board's decision to focus the disaggregation requirements on specific expense categories that were most requested by investors, there will likely be amounts in each relevant expense caption that do not fall within the required categories or the items on the lists that were just mentioned. For these other amounts, the board decided to require a qualitative description of those remaining natural expenses. The example on the left side illustrates the qualitative description of others amounts remaining in each relevant expense caption, which are shown as a footnote to each of the tables. In this example, you'll notice that most of the entity's expenses are represented by manufacturing expenses, which, like for most manufacturing entities, includes costs previously capitalized into inventory. Disaggregating expense amounts that include costs previously capitalized into inventory presents a unique challenge. On one hand, investors have consistently asked for greater visibility into the types of costs, like materials and labor, included in captions like cost of products sold, much of which has been previously capitalized into inventory. However, entities stated that the disaggregation of expenses resulting from the derecognition of inventory would be difficult, and some say impracticable, because it would require the retrospective identification of costs previously capitalized, among other reasons. On the next slide, we will discuss how the proposed update would address this issue by requiring more information about those inventory and manufacturing costs.
This slide shows the further disaggregation of inventory and manufacturing expense. As mentioned earlier, it's very common for employee costs, depreciation, and materials costs to be initially recorded as inventory before those costs are recognized in the income statement when that inventory is sold. To address the issue, first, the proposal would establish inventory and manufacturing expense as a separate bucket for capturing certain types of costs incurred. This bucket would include all of the costs either capitalized to inventory or charged directly to cost of products sold when incurred if they relate to an entity's manufacturing process. Then, entities would be required to further disaggregate that bucket into certain categories, which are purchases of inventory, employee compensation, depreciation, intangible asset amortization, and DD&A. Entities also would need to disclose how they define other manufacturing expenses. What's key here is that the amounts disaggregated from inventory and manufacturing expense represent costs incurred in the current period. This means items like current period labor costs and amounts incurred to purchase inventory, including any raw materials, would be disclosed in the period the company incurs those costs, as opposed to in the period the company sells the inventory. For example, if an auto manufacturer pays an assembly line worker over the course of the year, that worker's annual compensation would be included in the employee compensation component of inventory and manufacturing expense for that year, even if the company didn't sell all the cars that employee helped build during the year. Without using a cost incurred approach, there would not be a way to reflect all of that employee's wages in the expense disclosures. That is, some portion of those wages would still be sitting in inventory for the cars that have not yet been sold. A cost incurred approach is expected to provide more transparency into current period production costs and alleviate some of the concerns we have heard around the practicability of disaggregating costs of products sold when most of those expenses recognized were previously capitalized into inventory. However, in any given year, production is not likely to equal sales, and therefore costs incurred, such as the amounts paid to employees during the period, will not equal the amount of expense for labor recognized in the income statement. Therefore, to reconcile costs incurred to expenses recognized in the current period, an entity would present an amount for other adjustments and reconciling items, which may include amounts for items like foreign currency translation or the derecognition of inventory through transactions like the sale of a business, and an amount for the changes in inventory on the balance sheet during the period. Additionally, similar to the disclosure on the previous slide, there are likely to be other types of costs like freight and utilities that do not fit into any of the required categories for inventory and manufacturing expense. Those amounts may be included in other. Entities would be required to qualitatively describe what types of costs are included in other inventory and manufacturing costs as well as what types of items are included in other adjustments and reconciling items. These descriptions are shown as footnotes A and B to the table on this slide. This slide explains other key requirements of the proposed update. An entity would be required to disclose total selling expenses and how it defines selling expenses. An example of what this disclosure could look like is presented on the left side of the slide. It's important to note that entities would not be required to disaggregate selling expenses into the required natural expense categories unless selling expenses is presented as a separate expense caption on the face of the income statement. It's important to highlight that the proposed update would not establish any new presentation requirements. All the proposed disaggregation requirements would take the form of disclosures in the notes to financial statements. Additionally, most of the new disclosures would be required in both annual and interim reporting periods to provide investors with timely information about these expense and cost categories. However, the requirements to disclose definitions of selling expenses and other manufacturing expenses would only be required for annual reporting periods. And the final point to highlight is that the proposed disclosures would need to be provided in the period of adoption and going forward. This means that entities would not be required to provide the disclosures for the comparative prior periods. However, entities would have the option to provide information for those comparative prior periods. Illustrated on this slide is the comprehensive disclosure example that we walked through today. It's important to note that this is just one example that illustrates the proposed requirements. The proposed update includes two other comprehensive examples, one of a service entity and one of a bank, to illustrate how the proposed requirements may apply to different types of entities. The exposure draft is currently out for public comment, and the comment period will end in October of 2023. We really look forward to obtaining feedback from all of our stakeholders on this proposed update. And with that, we thank you for watching this video. We hope this is a helpful resource to understand the proposed requirements for the disaggregation of income statement expenses.